In this week's update, markets smacked by major left field event and strong jobs report. Perspective on the lithium market, and gold rises on the weaker dollar and economic turmoil. My name's Garry Davis. As always, this is general advice, and please remember to like and subscribe to the video. All right, a pretty interesting week, very disrupted towards the end. So let's have a look at what happened. The rally that we saw in January that definitely faded in February as the market got ahead of itself has really been killed by stronger than expected economic data, which came through on Friday night. And I think it's pretty obvious now when we look back over the last 2.5 months that too many market participants just tried to outthink the Fed. They were fixated on the fact that the Fed would have to change direction, that inflation had peaked, and the market was trying to price that in, and it's tried to price it in just a little bit too early. Maybe not. We'll see. Beg pardon. The jobs report came out at 311,000 new jobs created, which was much stronger. It was about 50% stronger than expected, and so that gives the Fed plenty of ammunition to keep their foot down and to take rates higher for longer than what the market was betting on. So, once again, the old adage of "don't fight the Fed" comes to mind. The market tried to outthink them, and the Fed wins in the end again. So that was Friday, but prior to that, there was a significant event with SVB Financial, which is the parent company of the Silicon Valley Bank, which has effectively collapsed. And whilst I expect that not many people have ever heard of it, it's the 16th biggest financial institution in America. And if this indeed does end up a failure, it'll be the second biggest failure in US corporate history. So this is a pretty big deal. You don't want to underestimate the potential ramifications. And the problem when a bank fails is you don't know who else is going to be caught up in all that action. And so naturally, the headlines have all come out. All the headline seekers are jumping on their soapboxes and screaming that will it bring down the financial system? And, that happens every time, and you don't want to buy into that argument. So the answer is, well, we can't possibly know whether it will significantly impact the financial system or not. There is no one on the planet can possibly know, because the financial systems are such a complex web of interconnected liabilities that you never know how this is going to play out. But money flows will tell us. If you just look at where the money is going and what the smarter people are doing with their money, then generally that's a pretty good indicator. To my mind, letting yourself get into this mindset of, what if this is a major financial crisis, and what if it affects the housing market, and what if this and what if that. If you go into that mode, it's worse than a waste of time, because what it does, it completely messes up your mind and really prevents you from thinking clearly and seeing clearly what the market is doing. So you just want to shut all that out. It's just what I call white noise. It's not relevant. There's just a few simple things that you can do. This is an unknown, so let's just focus on controlling what we can control. So work your plan. If you don't have a plan, then you shouldn't be in the stock market. That's pretty blunt and pretty simple, particularly in these sort of volatile markets. You've just got to have a very clear idea of what you're trying to do and how you're going to go about it. I've been advocating an approach for a long time where you actually compartmentalize your portfolio. Some of your holdings are going to be long-term and therefore unaffected by events like this. Other parts of your portfolio might be trading portions, and each one of those is going to have a process and a risk management strategy, or should have. And again, if it doesn't, you better get one pretty quickly, because these sort of markets can really disrupt your thinking unless you're very clear about what you're doing with each transaction within your portfolio. So they're the must-dos. American stocks, we'll just have a quick look at this slide and then go and look at some charts. The S&P ended up being down 4.5% for the week. That's a pretty major week. All sectors were down, but what I did notice, and you'll see in the charts, is that there is no obvious flight to defensives. I found that rather surprising when I saw the end result on Saturday morning, that I expected there to be a significant shift back to the defensive sectors. And there was a little bit on Friday, but it wasn't the huge turnaround, the flight to safety that you would normally expect. So at the moment, the charts are telling me that the market is, it's had its knee-jerk reaction. We might get some follow-through. No one knows. But again, just come back to, what does your plan dictate that you should be doing? US dollar index was pretty much steady. It was fairly volatile. We had some strength in the US dollar, and then we had some weakness at the end, which in itself is really strange. With the jobs report and the Fed making the statements that they're making, you would have expected the 10-year yield to be up above 4%, but in fact it went down. So I have no explanation for that one. Frankly, I won't even try. The VIX, that should be the VIX, was up to almost 25, and the 10-year, 2-year spread inched a little bit more negative, 0.9. And as I covered last week, these are long-term extremes in the market. All right, let's look at some key relevant charts. This is XLF, so this is the overall financial sector in America. And you can see what I mean here. Yes, Thursday was nasty. Big range candle, closed near its lows, quite elevated volume. And there was even bigger volume on Friday. And we were trading down quite negatively. But this is a fairly indecisive candle. This is telling you that buyers came in towards the end. Now, that is not what you'd expect if the significant players are expecting, an impending crisis. You just would not see a candle like that, or the probability is that you're not going to see a candle like that. There are no guarantees. But looking at that, and then let's look at specifically, this is the regional banking ETF, which is more reflective of what happened in the smaller to mid banking sector. Look at this candle. There's complete indecision. Yes, a huge gap down and traded very negatively. So partway through the session on Friday, this looked very, very ugly. But the buyers stepped in. So, that does not look like disaster territory for me, with everybody fleeing the system and going to defensives. Let's look at some of the key spreads. This is, first of all, I'll just look at the S&P. So that's what the S&P did. So we've now headed, so we broke out above this downtrending channel. So we had this very clear downtrending channel. We then established an uptrending channel and broke above this, and broke above it for quite some time. And I think a few weeks ago I mentioned the fact that whenever the S&P after a bear market can sustain itself above the 200-day moving average for more than about, I think it's 5 days, then the probability of being into a new bull market is exceedingly high. It's not guaranteed, but it's exceedingly high. Now, as you can see, this was above the red line, the 200-day moving average, for a long period of time. But Thursday and Friday brought it back down under that. So, we really need to see what the follow-through is on that. You can always forgive the market a little bit of an overrun on some of these levels. So let's look at the spreads. This is the NASDAQ 100 versus the S&P. Not a disaster in terms of flight to defensives. In fact, the NASDAQ really slightly outperformed the S&P in the latter half of the week. really important for the sustaining of a bull market. This is the semiconductors versus the S&P. Yeah, slight turn down on a relative basis on Friday, but honestly, Saturday morning, I expected to see this down here somewhere. So I was quite surprised. So this is much better than what I would have expected. The Russell 1000 growth versus 1000 value. Again, almost no response from the market on Thursday and Friday in terms of shifting the money flows. Yes, everything was sold down, but on a relative basis, people weren't deserting the ship. Now, the only real change here, so this is over the last quarter, this is the aggressive sectors: communications, technology, energy, consumer discretionary, materials, and then here's finance. And then at the bottom, over the last quarter, we've got staples and healthcare. Now, the only real change in this one was XLF, which fell from, probably being second or third or fourth in line, and it fell down to be a couple of places even lower, which is what you'd expect. But nothing dramatic there. And this is large cap growth versus large cap value on a weekly chart. Again, it just continues to look more positive than negative to me. So the money flows are just not screaming that this is a major turning point in the market. Now, that could change, but at the moment it's not. And if you start making decisions on the basis that it might, then you're completely on the wrong track, because then you're just jumping at shadows. So have a plan, work your plan, manage your risk, and that's really all you've got to do. This is the US dollar index on a weekly chart. So you can see we had quite a decent journey during the week, from almost 106 to a low of 104, so nearly 2% move, which is a fairly decent move in currency terms, but ended up going nowhere. And the impact on the Australian dollar, well, because commodity prices are under a bit of pressure, then the Australian dollar actually sold off on Friday night, as well as the US dollar. So that was an interesting move. So one would expect that our resources sector is probably going to continue to be under a little bit of pressure on Monday. All right, turning to the Australian market, 65.02 is where we finished. Our market lost, the index lost 1.9% across the week. I would expect that we'll open down on Monday. Not sure where we might go from there. My gut feeling is, for what it's worth, and it's probably not, gut feelings are never worth a great deal, but I wouldn't be surprised after the selling that we saw last week that we get a gap down open on Monday, and that could well prove to be the low price of the day. Wouldn't be surprised to see a panic sell-off in the first 30 minutes or so, and then a recovery. So if you are looking to liquidate positions, I wouldn't necessarily accept a really bad price on the open, because you may do a little bit better during the day. So materials and energy, they were down pretty sharply. So let's go and take a look at the Australian market. So there's materials. Well, first of all, we'll look at the ASX 200. So pretty dramatic day, as you can see, on Friday. And we're now rapidly heading back towards the 200-day moving average. So that'll be pretty key what this does on Monday and Tuesday. Materials sold heavily on Friday, and I think it'll be very very instructive to see what they do on Monday morning. Healthcare didn't do too badly on Friday. Financials, they took a hit, and I would expect they'll take a further hit on Monday. Energy, but a part of this was Woodside going ex-dividend by a pretty sizable dividend, so that was some of the impact in the energy sector. And this one's interesting. This is This is XEC, which is the benchmark for Australia's microcap companies. So they're companies ranked between 350 and 600 by market cap. Not too bad. Market wasn't panicking too much with that part of the market. All right, turning to, let's have a quick look at Bitcoin. Haven't looked at Bitcoin for a while. So Bitcoin started to come off fairly heavily on Thursday in particular, and finished back down at 20,000. This is gold on a weekly. So gold did kick up and finish the week quite strongly. So this 1800 level held. If we look at this on a daily, so at the moment you can only look at that and say, well, we've got higher highs. Let me just draw that in so that it's clear. So we've got higher highs, and we've now probably got a higher low. I think that's probably enough confirmation now. So you've really got to say that the odds are that the gold market is in big picture uptrend. And that's the response that we got to what happened in the US on Thursday and Friday. So pretty positive. If we look at the gold stocks, this is GDXJ. Not very much happening, but you'd have to say there was a bit of a panic going on in the market on Friday, and so that probably held gold stocks back a bit as well. But I think with the US market, the sectors that are being well supported, I think any weakness that we see in coming days or weeks is just moving towards a good buying opportunity. I really don't see that anything much has changed for those parts of the market. I'm not talking about the index, just talking about selected parts of the market. All right, gold ended up higher by $12, 1869. Central banks are buying at record levels, especially out of China. China clearly has a long-term plan to try and supplant the US dollar as the world's reserve currency. And to do that, they've got to hold far higher reserves of gold than they currently do. So I think that's going to be an ongoing theme for some time. The central bank holdings are the highest in 50 years. Now, there's an awful lot of geopolitical things happening at the moment. This is not just about, central banks thinking gold's a great place to be. This is a net balance between a lot of things that they're trying to juggle. The way that America has been, functioning in terms of sanctions is perhaps causing a lot of central banks to want to be holding some of their assets in alternative areas. So it's probably not surprising that we're seeing that. The Australian dollar gold price shot up nearly $100 from last week, 28.73. So we saw gold stocks do reasonably well on Thursday and Friday on a relative basis. Quite a few actually went up. So I think we'll probably see some more of that in the week coming. If we look at precious metal stocks, it was a pretty small response, but sentiment was weak in the US on Friday, so perhaps no real surprise there. Now this is just a quick graphic on the gold market. This is central banks' quarterly net purchases. So the net of buying and selling, and you can see the last 2 quarters over here, a huge increase in the amount of gold being purchased on a net basis by central banks. And then this one down here is central bank gold purchases as a percentage of total global demand, and this is courtesy of Bloomberg and Sprott. And you can see corresponding with that, with these big purchases, the percentage as the global total has shot up quite a lot. So you can see central banks certainly getting into the gold market. All right, turning to other commodities, copper slipped a little bit, only about 5 cents, and nickel is off down to 10.22, so it's come off quite a way. Nickel is now down a bit more than 20% in this calendar year, and that corresponds to supply from Indonesia rising, so that might just hold nickel back to a degree. WTI crude fell down to 76.7, but we did see a small rebound from 75. So that was like the stock indices. It did bounce a little bit off the lows on Friday. Turning to lithium, lithium prices are still declining, and people are still panicking about it, and analysts are still downgrading lithium stocks. But it's a real head scratcher for me, as I'll show you. So lithium carbonate in China has come down, these are US dollars, has come down to about 58,000. It was up in the mid 70,000 area, so it's come off a bit. Lithium hydroxide, I think, got to about 80,000. We're down to 65. But those levels were always very unsustainable. Spodumene has come back now to, this is spot prices, to 53.50 a tonne. But if we look at Pilbara Mines, now Pilbara Mines, according to their last report, the average price they realised in the first half was 7,447, and that's CIF in China. It's less than that from Port Hedland, but that's the China price, 7,447. But the key thing here is the cost of production. Again, on the landed in China basis, 1136. So you can see the massive price margin, or profit margin, I should say, that they're getting. So if the spodumene prices come off from a peak of 7.5 and it's down to 5.5, they're still outrageously profitable. So they've gone from just incredibly profitable to now just eye-wateringly profitable, and they're not expensive. So why the stocks are being sold off is just an irrational overreaction in the market, in my view. And so I think and I'm not saying that the prices of lithium stocks can't go lower, because they obviously can, but whatever they do, we're now in long-term buying opportunity territory. Might get cheaper, might get better, but this is still an enormously profitable part of the market. There's the spot copper chart. You can see not much change in copper, but nickel certainly did come down. Wrapping it up, in my opinion, I've been doing this for many decades, the only way to invest is as follows, and this is just really a recap of what I've been saying week after week for years and years. Follow the money flows. Don't get sucked into that what if game. What if this disaster unfolds? That's what the media want you to buy into. You just focus on risk, focus on probabilities. If you do those two things well, you do highly probable things, and you worry about risk before you worry about profit, then generally the profits take care of themselves. That's been my experience. We control what we can control, and just let the other stuff, the things that we can't know, the things that we can't control, just leave them be. Just focus on controlling what you can. And the reality in the market is that we can control most things. We can control what we buy, we can control how we buy it, what price we pay, how much exposure we take, how we take our profits, how open-minded we are. The vast majority of actions that you've got to undertake in the market are within our control. So just do that. Always consider the opposite case. Once a week I sit down and I look at things from the reverse, take off my typically bullish hat and put on a bearish hat and see what I can see, because quite often you might see things that you're missing. And above all, just be very humble and open-minded and prepared to shift your position, because the money flows do move backwards and forwards. But you've just got to be clear about what is a long-term trend and what is just short-term white noise. Doesn't really change things. And I think we're still in that situation at the moment. And the charts that I've gone through today, I would suggest, validates that. The finish that we saw on Friday, the lack of flight to safety, flight to defensives, tells you something about the mindset of the market. Portfolio analyst last week, we looked at the lithium market in perspective, so in more detail than what I talked about before, and also more on technical analysis. And the better your technical analysis skills, the the better off you're going to be. And there's a huge amount of that as an educational function within Portfolio Analyst. That's it for this week. There's my email address and more information on the website. I'm sure it'll be a very, very exciting week, and I'll be back with you next Sunday. Cheers.